You ever have one of those weeks that feels like a roller coaster you didn't ask to ride? That's what happened with Opendoor this week. We went from earnings excitement to a brutal sell-off, and now, as we head into the weekend, the stock is showing signs it might be thawing out. Today, it closed at $1.95, trading about 5% higher. It's tempting to chalk that up to pure volatility, but there are bigger things at play, things that could reshape this story in the weeks ahead. Let's start where it began. On Tuesday, Opendoor reported Q2 results that actually looked pretty strong. Revenue was $1.6 billion, they sold over 4,200 homes, and for the first time in 3 years, they had a positive adjusted EBITDA. That's not small potatoes. It shows the company has managed to tighten operations and control costs even when margins are under pressure. But then came the guidance. Management warned that the second half of 2025 will look softer. High interest rates and a seasonal decline in real estate activity, especially in Q4, will slow acquisition volumes. That was enough to trigger a nearly 25% drop after hours. Sometimes, the market reacts emotionally, even when the fundamentals haven't changed that much. By Wednesday and Thursday, things began to calm. Volume wasn't crazy, but the chatter on forums suggested a shift, from fear to reflection. Comments from Eric Jackson, the activist investor, reminded people that he still saw value here. On Thursday, he even helped amplify a letter penned by retail investors calling for more clarity and action from management. That chatter matters when the retail crowd is such a big part of this stock story. Then Friday happened. The bounce to $1.95 wasn't just random. A big driver came from a headline that JPMorgan now expects not just 1, but 4 Fed rate cuts starting in September. That's a huge pivot from what they'd thought before, and it gives real tailwind credibility to names like Opendoor. Why does that matter? Because Opendoor's model depends on fluid housing demand. If mortgage rates fall, suddenly buyers who are priced out return to the market. Opendoor can move more homes, replenish inventory more quickly, and rebound operationally faster than many people think. The bounce today wasn't just momentum, it reflected belief in that potential pivot. And it's not just JPMorgan. S&P and other strategists remind us of how the housing market reacts historically to rate cuts. When the Fed eases, particularly outside a recessionary environment, equities, especially housing-related ones, often rally. According to LPL Financial, the S&P 500 has averaged a 30% return during rate cut cycles since the 1970s, though of course, every cycle is different. That context adds weight to today's bounce. It's not just timing, but history saying, hey, don't count this out. Now, let's be measured. This isn't shouting rocket launch or calling a massive short squeeze just yet. We're not in the clear. Higher rates, affordability issues, and a housing market that could remain sluggish even with cuts are real headwinds. But right now, the narrative is shifting, from cautious to hopeful, without hype, just realignment. If you're watching this name, here's what to keep an eye on over the weekend and into early next week. First, any economic data that reinforces the Fed cut thesis, like softer job numbers or cooling inflation, can give this bounce legs. If that plays out, we could see continued strength going into next week. Second, investor sentiment. Is talk on Reddit and YouTube shifting from downside only to maybe this isn't done yet? That on-ramp matters when charts and sentiment travelers collide. Third, any response from Opendoor's leadership. We've had their cautious guidance. Now, if they can show where efficiency is improving, or even highlight seasonal inventory planning, that will reassure more investors that the rebound isn't speculation, it's strategic. There's also the bigger housing picture. The affordability crisis is real. Inflation-adjusted rates, a shortage of supply, and high prices are weighing on buyers. A Fed cut helps, but it doesn't fix everything. This remains a longer-term restructuring trend, not just a rate fad. Still, Opendoor's technology, pricing model, and infrastructure put them in a unique position to benefit once market flow improves. So, the setup going into the weekend? Optimism is cautiously creeping back in. The bounce to $1.95 isn't a home run, but it's definitely a positive sign. The macro backdrop could get friendlier, the business itself has swung to profitability, and there's a growing chorus of investors tired of waiting. If the Fed does act in September, we may look back at this week as the quiet before the storm. And for those who believe in the long-term potential of both the business and the broader housing recovery, this could be the inflection point. That said, volatility isn't gone, and we still need follow-through. The key now is to watch how sentiment evolves, track incoming economic data, and see if Opendoor responds with clarity. Because this isn't a knee-jerk bounce. It's a pivot point, and that's something worth paying attention to. Let me know how you're feeling about it. Are you holding through the bounce, adding, or waiting for more confirmation? Drop it in the comments. Hit like, subscribe, and we'll unpack what comes next. Here's to watching a story that's far from over.